Good morning, everyone. Neil here, your trusted mortgage agent. I have a quick update based on the latest interest rate announcement from the Bank of Canada. If you prefer watching videos over lengthy newsletters, this one's for you. So let's dive in. At 9:45 a.m. this morning, the Bank of Canada delivered a much anticipated rate drop, decreasing its policy rate by 0.25% from 4.75% to 4.50%. This marks the second consecutive rate drop in two meetings, bringing the prime rate to 6.70%. So, what does this mean for you? For those with a variable rate mortgage or loan, this would translate to a reduction in monthly interest costs of approximately $20.83 for every 100,000 of mortgage. However, if you're looking to buy a new home or refinance an existing mortgage, there will be little to no improvement in your eligibility to increase or to secure a higher mortgage amount. So, what prompted the Bank of Canada to make this decision? Recent economic updates likely influenced this move, and it's not looking pretty out there. The CPI, or the Consumer Price Index, continued its downward path, with June at 2.70% versus 2.90% in May. GDP growth remains weak, with only 0.3% growth in April, despite the continued increase in Canadian population numbers. Employment growth is losing steam, with the economy adding only part-time jobs in May and the economy losing jobs overall in June, most of them being full-time positions. If this trend of softening economic activity continues, we may see another 0.5 to 0.75% of cumulative reduction in the prime rate before the end of 2024. This could mean potentially 0.25% reductions at each of the upcoming Bank of Canada meetings for this year, which should possibly bring the prime rate below 6% before 2025 begins. Wouldn't that be a good New Year gift? Now that we've covered a bit of the macro picture, let's talk about the mortgage market itself. So first, let's talk about bond yields and the fixed rate spread. The spread between bond yields and the fixed rates continued to narrow, but remain higher than the long-term average. This spread should decrease as organic demand for mortgages increase. How about fixed rate and variable rate mortgages? So variable rate mortgages are still priced higher than fixed rate mortgages, but the gap is narrowing. Currently, there is 1% to 1.35% difference depending on the product, indicating that there is significant scope for reduction in the spread. We will see a relatively limited reduction in the fixed rates. I'm predicting maybe 0.50% to 0.75% in the coming 12 months. How about the variable rate discount? So, as you know, variable rates are priced at a discount to the prime rate. But these discounts are currently lower than the long-term average. We can expect these discounts to increase over the next 12 to 18 months as the demand for variable rate products rise. So what are we betting as far as prime rate is considered? So borrowers opting for a new variable rate mortgage or choosing to remain with a variable rate mortgage are betting on a decrease in the prime rate by at least 1% within the next 12 months. And that's if that turns out to be the case, then it would be more favorable option over a 3-year fixed choice. The probability of this playing out is looking quite good right now. So, what should you do? Let's first talk about the 3-year fixed rate mortgage. This option offers a lower payment as compared to a variable rate product. However, if you have the flexibility in your monthly budget and also don't have issues with qualification, then choose a variable rate product as it would likely be more cost efficient over the next 3 years. What if you have a mortgage renewal coming up? A 3-year fixed rate mortgage would allow you to renew a mortgage and avoid a relatively higher payment associated with a variable rate product. It would also provide the flexibility to renew sooner, potentially securing a lower rate at the end of 3 years as compared to committing to a longer 5-year term. However, there is a word of caution for those considering a fixed rate mortgage. If you're opting for a fixed rate product, be sure to review the terms closely. A significant drop in interest rates from today could make it very costly to exit the product before the end of the term you're signing up for, as the penalties will be increasingly substantial. Even a basic 3-month interest penalty is likely to be around $10,000 for an average size mortgage these days. Please note that these are very generalized recommendations, and you would be best advised to seek personal advice when facing a mortgage decision. Uh, do note, I'm just a phone call away, so feel free to call me. So that's it for today's update. For more detailed insights and charts about bond yields, interest rate trends, etc., be sure to read our latest blog. You'll find the link in the description. As always, if you have any questions or need personalized advice, feel free to reach out. Thanks for watching, and I will return with the next update on 4th of September.